The next session is titled The Impact of COVID-19 Crash on Investors. May I now invite the moderator for this session, Mr. Rajiv Thakkar. Mr. Thakkar is the Chief Investment Officer and Director at PPFAS Mutual Fund. Over to you, Mr. Thakkar.
Hello, good evening. It's my honor and my privilege to be the moderator for this session at the India Wealth Management Conference, the 5th session of the conference. This year we are having the conference online, and we have a wonderful speaker today. We have the founder and the chairperson of Research Affiliates, Rob Arnott. Rob Arnott is considered to be the grandfather of smart beta investing, and he's been in this field when the field did not exist. So just to give you a background, he's a person who's majored in math, in computer science, and in economics. So he's a geek from a time when geeks were not as well known. And not only is he an academician and someone who's written more than 100 papers in factor investing and various other investment related topics, he's also a practitioner. So it's not that he just sits in an ivory tower and churns out research. He's someone who actually applies that research to the real world. However, today I have this small fear that the audience, which is the wealth managers and people who allocate money for clients, may be a bit shaken up with what Rob is going to share with us. Rob has shared his outlook on what the next decade will look like, and he has this prognosis that maybe a 60-40 kind of portfolio in the coming year could give maybe 0 to 1% kind of return in the US context. And he's also used the dreaded B word, the bubble word, in the context of some asset classes. So I'm sure this is going to be a very interesting session, and we all would be eager to hear what Rob has to say and share with us. So without taking much of your time, I'll hand over the floor to Rob, and we'll listen to his presentation, and then maybe we can quiz him on some of the areas which are not that clear to us. Over to you, Rob.
Okay. I believe you have some slides for me. If you could put those up, I'll take it away. The COVID-19 crash, which happened, of course, this past spring, is going to have lasting influence on investors, as will the lockdown. The lockdown, once it ends, will still have changed human behavior, will still have changed the way we view interactions, will change the way we use office towers, the way we use in-person transportation to meetings. It will be a more technologically centered world once everything settles down following the end of the COVID pandemic. But there's an interesting set of observations that I wanted to explore. There's bailouts on a multi-trillion-dollar scale. Bailouts, as we all know, have both good and bad effects. The bailouts can have the effect of cushioning the blow of the lockdown, of the COVID pandemic, for companies that couldn't otherwise make it through the pandemic, but it also will prop up zombie companies. And it's noteworthy that at least in the US, the bailouts have mostly gone to established businesses. That is to say, those that are politically connected. A lot of it did not filter its way down to small businesses. Bailouts for individuals also have had some good effects and bad effects. They've helped cushion people's lives and livelihoods during a period of time when they couldn't go to work and couldn't earn money. But on the other hand, at least in the US, the way that the cash distributions worked wound up giving the majority of the people who signed up for the unemployment a raise in pay, giving them an incentive not to go back to work. I believe the last tally showed 68% of those who received the federal unemployment received a raise in pay. The unemployment was a flat $15 an hour, and it was on top of state programs that would typically give $10 or $12 an hour. So that's $27 an hour to not work. It was further supplemented by $1,200 for everyone who made less than $100,000 in the United States, just directly wired into checking accounts. This kind of profligacy will have lasting impacts by boosting our national debt by multiple trillions of dollars. The expectation is that next year we'll have gone through the $30 trillion national debt level. We broke through 20 trillion only 3 years ago. So the impact of the bailouts, the efforts to bail out and prop things up, are likely to be staggering. Now, the interesting thing is when you engage in fiscal and monetary stimulus, I hate attaching the word stimulus to these spending binges, because it really doesn't stimulate anything. The macroeconomy may be lightly stimulated in exchange for being depressed subsequently, because money spent now can't be spent later. And so the stimulus may cushion the economic shock on a short-term basis, but the stimulus doesn't create the goods and services that people want to buy. So the money has to go either into efforts to purchase goods and services that aren't being provided, that means inflation, or efforts to just set aside the money for later use, that means asset inflation, asset bubbles. And we're likely to see a bit of both. People became complacent after the global financial crisis, saying, see, the massive stimulus, multi-trillion-dollar stimulus in the global financial crisis did not trigger inflation. Well, this is on an entirely different scale. And in the global financial crisis, it didn't make its way into people's pockets. The stimulus went through the banking system, through the capital market system, fueled asset bubbles, and did not make its way into people's pockets for immediate spending. This stimulus is a little different, and a fair chunk of the money is going straight to people's pockets. So we're already seeing signs of inflation in lots of the parts of the US economy. That's less true in Europe, and certainly far less true in the emerging economies of the world, because for the most part, the emerging economies of the world can't engage in stimulus on this kind of scale. And in Europe and Japan, the magnitude of stimulus was distinctly less than in the US. The US stimulus was larger than Japan and Western Europe combined. So then there's for some reason this is kicking me out. I'll just work with it this way. The policy missteps also enter the picture in a very big way. Okay, let's try moving forward. I apologize, this is not working as well as I would have hoped. There we go. The policy missteps are also noteworthy. In early June, the Centers for Disease Control in the United States, our primary national health care agency, estimated the mortality associated with COVID-19 at just over 0.25%. Now, that sounds absurdly low. We've got 20 million cases around the world. Nearly 4% of them have died. So how could the mortality be 0.25%? Well, that's 20 million known cases in the world. The number of deaths is likely more accurate. Because of undercounting in the emerging economies, we're probably already well past 1 million deaths worldwide. But 20 million cases? My goodness, how many people have not been tested? How many people were asymptomatic? So the Centers for Disease Control firstly estimated that the mortality rate, inclusive of anyone with symptoms, not just those who were tested. Anyone with symptoms, their estimate was 0.4 to 0.6%. Their estimate was that 0.3 to 0.5% were utterly asymptomatic. Multiply the two, 30 to 50% were asymptomatic. Multiply those two together and you get about 0.25% actual mortality. Well, this is an official government estimate, and they're standing by those numbers. So did it make sense to blow up the global economy, to lock down the global economy for a pandemic, and it is a pandemic, that kills about 1/4 of the people who contract it, and half the people who contract it don't even know that they contracted it. My wife is an example. She was in Europe in February and finally got tested in May, and she had the antibodies but not the virus. So she caught it, never even knew it. There are countless millions of those people. So in all likelihood, the number of people who've actually had COVID isn't 20 million. It's probably 10 times that number. Large numbers of people have been exposed and turn out to have some sort of resistance. We have some interesting controlled studies in academia. People love controlled studies. There were controlled studies on two ships, the Diamond Princess and the Theodore Roosevelt, the former a cruise ship, the latter a military vessel. And in the case of the cruise ship, there were 3,500 people on board. Every last one of them was exposed. 700 tested positive. So that meant 80% were exposed but didn't catch it. The other thing that's interesting is that of the 700 who caught it, 14 died. That's 2%. That's not 0.25%. But the average age on the boat was 72 years old, and the average age of people dying was 80. Every death is a tragedy. But one thing that I think we're overlooking is that having yourself thrown out of work, having your hopes shattered, your dreams shattered, your employer shut down for good, this can lead to drug overdoses, suicides, domestic violence, the list goes on. So it's entirely possible that the lockdowns will actually kill more people than COVID, but we'll never know because those aren't counted and attributed correctly. We also saw the race to zero interest rates accelerated. Europe was already there, Japan was already there. The US was not. Now we are not all the way out the yield curve. The long end of the yield curve is still in the 1.25% to 1.5% range, but that's an awfully skinny yield. The central bank is also seeking to shift the inflation policies from seeking 2% inflation to seeking 2% long-term average inflation, where we've been well under that. We've been in the 1 to 2 range over the last decade. So they've signaled that they're very happy if inflation goes above 2% in the years ahead to catch us up. To catch us up to what? The purpose of money is as a medium of exchange and a store of value. And if it isn't a store of value, then it has diminished relevance. So there's a risk that we turn the US dollar into yet another currency that people will use interchangeably with other currencies, but won't view with the respect that it once had. And so I think the race to zero interest rates and the race to marry zero interest rates with inflation that's 2% above those interest rates, creating a suppression of wealth, what some people call the asphyxiation of the rentier, those who depend on investment income being put in a position where they can't make ends meet. Well, this includes all the retirees dependent on investment assets, whether directly through their own investments or indirectly through pensions. I did a recent paper entitled The COVID-19 Crash and the Abandonment of the Pensioner. I pointed out that in the first quarter, at least in the US, your 60-40 portfolio was down over 10% because the stock market was down 20%. But the net present value of liabilities, correctly accounted using market interest rates, was up 15% in that same quarter. Well, that's a 25% drop in net funded ratios in a single quarter. Now, has that improved in the market rebound since then? No, because interest rates have gone lower. So yes, the 60-40 investor is now in the black in the US and only slightly in the red in developed economies outside the US. But the net present value of pension assets has gone up still further. Why doesn't this show up in the data? It doesn't show up in the data because actuaries do not use forward-looking rates of return for forecasting returns on pension assets. And so the discount rate that's used for pension assets is a blended rate that consists of bond yields for the bond investments and past stock market returns for the stock market investments. So in the United States, the average public pension fund is using an assumed rate of about 7%. Where are you going to get 7% when the stock market yields less than 2%, and is priced at a Shiller PE ratio of 32 times the sustainable long-term 10-year average earnings? And we've got to struggle to get back to those average earnings too. Where on earth are you going to get a 7% return? You won't. So this race to zero interest rates has daunting effects on creating a misallocation of capital, malinvestment. The money flows to those who don't need it and not to those who do. If you're a borrower who needs the money, you won't get the loan at any rate, let alone zero. If you're government able to print the money to pay back the loans, or if you're an extremely high quality company with no risk to the lender, you can get these near zero rates. And what of these companies? Are they companies that are going to do bad things with the money? No, but they're going to put it to its best use, which in many cases is, for example, stock buybacks. I'm not opposed to stock buybacks. I think they're a perfectly sensible way to use capital for a company that doesn't have good internal reinvestment opportunities that provide long horizon opportunities for business development and product innovation. But the simple fact is most of this money doesn't go to business development and the launching of new long horizon initiatives that would involve a certain measure of risk. So the zero interest rates create an environment of stock buybacks, not innovation, an environment in which those who need the money don't get it, and an environment not at any price, and an environment in which we become enablers of government waste. I was at a political meeting over the weekend, visiting with several senators and about 20 members of Congress. And I asked them, of the $3 trillion stimulus that was just passed a few months ago, how much of it do you think went to good use and how much of it do you think was actually wasted? And the consensus seemed to be that $1 trillion was well spent on necessary responses that would help people weather this storm, and $2 trillion went completely to waste. Well, that's a lot of waste. And so we're already pursuing modern monetary theory. MMT is talked about as an idea that some folks on the hard left want to pursue. We're already doing it. And we're doing it here, we're doing it in Western Europe, we're doing it in Japan. And it facilitates government spending, which, if well spent on things that will matter 10 years from now, can be very good, very useful spending. But if it's thrown away, then all you're doing is crippling the economy and diverting resources from activities that can actually build businesses, create new products, and so forth. So I mentioned already that one of the impacts of vast stimulus spending, whether monetary or fiscal stimulus, is that if it doesn't get put into people's hands to spend, and if they don't have anything to spend it on, it goes into a holding pattern. Where is that? It's the capital markets. It bids up prices of financial assets. And that's exactly what we've seen. The US, of course, has had the biggest rebound in the world since the COVID crash. And that's a function of having the biggest stimulus in the world. When money flows into the markets, there's a seller for every buyer. So you aren't pushing money into the market, you're pushing prices up to a point where somebody else who already has those investments is willing to sell them to you. And because of that dynamic, it's the supply and demand that pushes the prices up, not the flow of money per se. The appetite to flow money is what drives the prices up. Now, I've written quite a bit on bubbles in the last couple of years. And one of the things that I feel quite proud of is that we created a definition of the term bubble that can be used in real time. We all hear about the Japan bubble, the tech bubble, country bubbles. The Abu Dhabi had a bubble about a dozen years ago. Bubbles exist all over the world. They're a common phenomenon. They exist in a micro form in individual assets. They exist in a macro form on broad markets. But people confidently describe something as a bubble only after the fact. Well, you don't have to do that. The definition that we came up with, which is, I think, a robust definition, it is subjective, but it's not all that subjective. The definition would be that if you are using a valuation model like discounted cash flow, you would have to use implausible assumptions to justify the current price. That's part one. Part two, the marginal buyer has zero interest in valuation models. Don't bore me with that stuff. This stock's on a roll. Let's use Tesla as one example and Apple as another. Tesla. Tesla has 1/30 the annual car sales of Toyota. It's worth nearly twice as much as Toyota. Toyota did not lose money in the global financial crisis. It has not lost money in the COVID crisis. It hasn't had a money-losing environment in many years. You'd have to go back into the last century to find any year in which Toyota lost money. It's also an innovator, one of the pioneers of hybrid cars, and is catching up very fast with Tesla on the all-electric cars. And so it's been an innovator. It's been a profitable innovator. It's 30 times the size of Tesla. It currently trades at a valuation of $20,000 for each car that they've produced in the last decade. $20,000 per car. Tesla's trading at $400,000 per car that they have ever produced. Well, that's interesting. So what kind of growth would be needed to justify the current price? No plausible growth number would fit. Does the marginal buyer of Tesla care about valuation models? Heavens no. Apple's expensive. It crossed the 2 trillion valuation mark. That's a highly valuable company, but it has cash reserves on the sidelines that measure in the hundreds of billions. It has vast sales around the world. It is trading at very high multiples, but the assumptions you'd have to put into a valuation model are aggressive, not implausible. The marginal buyer of Apple, some fraction of the marginal buyers aren't chasing a fad or chasing a story of how it will grow. They're doing analysis, and some of them are using valuation models. So Apple is not a bubble. Microsoft is not a bubble. Tesla's a bubble. And so you can use this to gauge basically most of the FANG type stocks and most of the BAT type stocks qualify as bubbles. You cannot come up with forecasts for their future that would be plausible and would justify the current price. So this is an area where stimulus does some real damage. It encourages formation of bubbles. And of course, we've seen the rise of the Robin Hood investor, where investing is actually a click game on your laptop. And it's a click game with some real consequences. And yes, there will be tears when this bursts, and bubbles do burst. There will be tears. Now, the flip side of a bubble is an anti-bubble. It's an asset that, let's flip around that definition, an asset where you would have to use implausible assumptions to not earn a risk premium. And the marginal buyer has no interest in those valuation models. There are anti-bubbles also, not in individual assets. Individual assets, you can always create a plausible scenario where the net present value is zero. You can always do that with an individual asset. Can you do that for a broad segment of the market? Well, emerging markets value is currently trading at a Shiller PE ratio of 11. Price relative to 10-year smoothed earnings, sustainable long-term earnings of 11 times those earnings. Currently yields about 5%. Now, with interest rates near zero, you have to use implausible assumptions to not earn a risk premium with emerging markets value. Let me get a little more controversial. State-owned enterprises. People shun state-owned enterprises because the state controls whether you get paid anything. The state can simply decide, we're not going to pay our external investors anything. But if they want access to the capital markets on a long-term basis, they better have let some of the crumbs fall to the external investors. And they know that. Well, there once again, the yield is about 5 and the Shiller PE ratio is about 8. Price relative to 10-year smooth earnings is about 8. They don't have to toss many of the crumbs to the external investors in order to assure a very respectable risk premium. So there are anti-bubbles as well. Now, when you get Vitaly Kolesnik in an earlier CFA presentation to the India Society, went over our analysis of the spread between growth and value. And this is a global phenomenon. It's most pronounced in the US and in emerging economies of the world. The spread between growth and value stocks is the widest in history. In the US, you have the FANMAG stocks utterly dominating. That's the FANGs plus Apple plus Microsoft. That's utterly dominating the growth side of the market. These 6 companies currently represent 25% of the entire US stock market. Are they 25% of the US economy? No, they're about 4% of the US economy, measured in terms of sales, profits, book value, dividends and buybacks, measured in terms of financial comparators with the rest of the publicly traded macroeconomy. They're about 4% of the economy and 25% of the market. Well, that's pretty stretched. And the flip side is that value is trading very cheap. So the spread in price to book value between the 30% most expensive stocks in the market and the 30% least expensive on a price to book value basis is currently 12 to 1. 12 to 1 ratio. That 30% growth segment of the market is 12 times as expensive as the value segment. What if you do it on price to sales? Well, that's a 16 to 1 spread. What if you do it based on price earnings ratios? That's an 8 to 1 spread. And then when you look at the peak of the tech bubble, what were those multiples? Well, price to book value spread was 9 to 1. Now it's 12 to 1. We're 30% stretched relative to the peak of the tech bubble. And then we come to emerging markets where the spread is even wider than in the US. The BAT stocks, Baidu, Alibaba, and Tencent, are fully as expensive on measures like price to sales and price to book value as the FANMAGs, fully as expensive. And if they're as expensive and emerging markets are half as expensive as the US, then by definition, the value side of the emerging markets has to be at a deep discount to the valuations of US value stocks. So I'm often asked, well, why should I invest in emerging market stocks and take the currency risk and put my money into overseas markets when I can buy companies like Coca-Cola that do a lot of their business in emerging markets? And my response to that is very simple. If you looked at Coca-Cola's valuation multiples compared to emerging markets, let alone compared to emerging markets value stocks. And so the way to capture these opportunities is directly investing in them. I'm also constantly asked the question, well, what about the COVID-19 pandemic, which is racing through the emerging economies of the world and killing many, many people? My response to that, and I'll be very interested in your thoughts on this, Rajiv, whether I'm completely mistaken on this, but my thoughts on this are very, very simple. And that is that the emerging markets are used to having a crisis every few years. The US and Western Europe, not so much, not of this magnitude. And people in emerging economies are resilient. They're used to having their dreams and expectations blown up every few years. We aren't. So my expectation is that the emerging economies will shrug off the impact of the pandemic faster than the US and Western Europe, that the ways people do business will be less severely altered on a permanent ongoing basis than in the developed economies of the world, and that the emerging economies will resume their march towards Western Europe and US levels of per capita income and affluence, much as has taken place over the last quarter century, that the emerging economies will resume emerging. The resilience in emerging economies is impressive relative to the developed world, where something like this, we've had 3 shocks at the end of 3 decades: global financial crisis, the tech bubble bursting, and now the COVID pandemic. To us, this is the 3 biggest shocks we've had in the entire post-World War II era. To emerging economies, these are just another shock like you get 2 or 3 times a decade. Am I wrong on that? If I'm right on that, then the emerging economies will be the place to invest in the years ahead. We also have done a lot of work. Those of you who have visited our website, you can Google Asset Allocation Interactive, and it'll take you straight to the Research Affiliates website, where we estimate asset class real returns across 130 different markets around the world, including Indian stocks and bonds, including individual stock markets, as down to levels as small as frontier markets. And so what we do is we estimate forward-looking rates of return, and we do it in a very, very simple way. What's the yield on the investment? What is the growth in income on the investment? For stocks, earnings and dividends grow a little faster than CPI inflation, but a little slower than the macroeconomy. Why slower? Because the macroeconomy grows by dint of existing enterprises growing plus new enterprise creation, entrepreneurial capitalism. So existing enterprises cannot grow as fast as the macroeconomy, but they do grow in real terms. So you get real growth plus a yield. With bonds, you get yield minus inflation, and if there's risk associated with it, minus default risk. We then add or subtract a revaluation component, as, for example, Shiller PE ratios mean revert towards historic norms, or credit spreads mean revert towards historic norms. We make a very simple assumption. We don't know if mean reversion is going to happen or not. So we simply say, let's assume that we go halfway back to historic norms. US Shiller PE ratio 32. The historic norm is 18. We don't know if it's going to go back to 18 or is going to stay at 32. Let's go halfway. Let's go to 25. Let's take our time at it. Let's have it happen over 10 years. Well, what's that 10-year decline from 32 to 25 worth? It's minus 3% a year. Now, if the yield in the US is just under 2%, 1.8, and the historical real growth in earnings and dividends is about 1.25% a year, that's a 3% real return. But that's what you would earn if valuation levels 10 years from now are still at 32 Shiller PE ratio. If there's any mean reversion, halfway mean reversion takes that entire return back down to zero real. So we're now forecasting zero real return on US stocks over the coming decade. The same arithmetic on emerging markets gives you a 7% real return. 7% is a terrific real return. Doubles your money in real terms every decade. And most of us have a time horizon measured in multiple decades. Well, I'm 66, so maybe not that many multiple decades, but I am planning to be around for a while. So these long-term return forecasts still matter. We do this on 130 different asset classes. So as we look around the world, we see a whole spectrum of opportunity, just not in the US and not in developed economy bonds. Emerging market sovereign debt currently yields something on the order of 0.5% less than US junk bonds. Is the default risk as bad as US junk bonds? Well, maybe for Argentina it is, but for the broad emerging economies of the world, the historical default rates are measured in well under 1%, and the yield spreads are in the 3 to 4% range. So that's a terrific opportunity. So we use these kinds of very simple measures to gauge where the long-term opportunities are. And then the key as an investor is patience. Now, the paper that I wrote recently, the COVID-19 crash and the abandonment of the pensioners. Pensioners are in trouble in a zero yield environment. We are in an environment where the entire developed world is seeking to suppress anyone dependent on income. And, you know, it's something that way back in 2001, I gave a speech to the SEBA group, which is the largest corporate pensions in the United States. And I made the observation that what can't happen won't happen. And what can't happen is the baby boomers, the largest generation in history to that time, and the largest generation as a percentage of population ever, baby boomers could not retire on schedule. And so I said, I don't know how the mechanism is going to work, but we will be forced to revisit how soon we retire. I speculated on the impact on capital markets, suggesting that returns would be lower than expected over a 20-year span. They certainly have been. Speculated that interest rates would be lower, reducing the payout to those who were retiring. That certainly happened. And I also speculated that Social Security and Medicare were going to be much too expensive for society to tolerate their cost, and that the net result would be that the benefits would have to come down, or the age of eligibility would have to go up, or there would have to be means testing to deprive those with personal resources of access to Social Security and Medicare. And bit by bit, that's been happening. Politics is not the business of trying to anticipate future problems and set them aside and make them not happen. Politics is in the business of responding to crises. So Social Security and Medicare will not be materially altered until they're in crisis. But that crisis is coming and coming very soon. So that covers the formal observations I had. I believe, Rajiv, you have a number of questions, and I'll be very interested to hear what questions your audience has sent in to us.
Some very interesting points you had. One was the value versus the growth stocks kind of scenario across the globe and even in India. So based on the asset allocation framework that you have and where you highlighted emerging markets are looking attractive, any specific thoughts on India as a market, both in terms of bonds as well as equities?
Well, in India, the stock market in India is not one of the less expensive of the emerging markets. I noted that the way we forecast returns for markets is yield plus growth, plus or minus mean reversion and valuations. For India, you'd get a respectable return on yield plus growth. Not respectable by historic standards, but respectable by global standards. But your valuations are higher than your historic norms, so the mean reversion would be downward, and so the forward-looking returns would not be brilliant. The countries that are trading well below historic norms, countries like Turkey and Russia, ouch. Our models do not have a Putin component. They do not have an Erdogan component. They don't have a component that acknowledges the appetite for dissipating national treasure and blood on excursions into adjoining countries, on an oligarchy that thinks that expropriation is a perfectly legitimate tool of control. So you have to take all of that into account. And so when I look at our forward-looking returns for Russia, 15% real, 15% real per annum compounded for 10 years. I look at that and say, yeah, that's if Putin doesn't do anything strange. Well, he's going to do strange things. He just will. And so I look at that and say, okay, if he doesn't do a lot of strange and damaging things, we'll get a really impressive return. Do I want all of my money there? Heavens no. Just because the model says 15% return doesn't mean that you're going to get it. It means you're going to get it if everything goes according to plan and if valuations mean revert towards historic norms. Same thing applies to Turkey. And so when I look at these, I think, gosh, I want to have a decent size investment in these economies because they're very cheap. And because if nothing horrible happens, they'll provide wonderful returns, but I don't want a huge investment. Now, the simple fact is that because they are trading so cheap, they're a very small part of the emerging markets index. I mean, the BAT stocks, those three companies are worth more than Russia and Turkey combined by a factor of at least 5. 3 stocks. Okay, would I rather have that much money in 3 stocks or in 2 large economies with tremendous opportunity for upward mean reversion and valuation? I'd rather have it in those 2 countries. So that's the way we can think about these opportunities. We're contrarian investors. Contrarian investing is inherently uncomfortable. Anything that's newly cheap got there by inflicting pain and losses. Human beings experiencing pain and losses say, get me out of here. I don't want any more of this. When in fact, it's already happened. The fact that it's already happened doesn't mean that it won't happen again, doesn't mean that you won't feel more pain. You'll feel more pain until the market turns. And so contrarian investing means buying what's out of favor, feeling and looking like an idiot until the turn happens, and patiently averaging in despite that discomfort. At the high performance end, it means looking at bubble stocks and saying, yeah, these are likely to go up before they go down. The next step is more likely up than down. I'm not going to participate. I'm going to step away. But one of the other things that we've noticed about bubbles is they continue until they don't. And when they don't, they inflict savage damage as the bubbles burst. But until that happens, they can go a lot further than anyone could imagine. I knew people who were short Tesla at 300. Now it's at 2,000. Is it more likely to hit 3,000 next or 1,000 next? I would bet it'll hit 3,000 before it hits 1,000, but I don't know. Simple fact is, shorting bubble stocks is very dangerous. Not owning them is perfectly reasonable and is rational if you're patient.
So when your models are saying, let's say 15% for Russia kind of returns if everything goes well, India, I suspect, given that valuations are elevated, would be sub 7 in your view?
Oh yeah. I think I should have looked it up before this session, but I think our expected return for India is in the 3 or 4% real range. Anyone who's curious, go to Asset Allocation Interactive, which I will do right after we're done, and look it up.
Sure. So all the financial planners and wealth managers on this conference should tear away their 10% projections that they have from equities, if that is correct.
Certainly pair your expectations, because 10% returns, if your starting point is a yield in the low single digits, you would need growth of earnings and dividends of high single digits to achieve that 10% return. How plausible is that? It's a stretch. And then you'd also have to have no mean reversion in valuations. If valuations return towards historic norms, then whatever return you're getting on yield and growth is compromised. People think that just because India is likely to have 4% real growth in the years ahead, or perhaps even 5%, that means that stock earnings and dividends should rise 5% real per annum. They don't. They grow slower than the macroeconomy. India is an entrepreneurial hotbed. There's a lot of new businesses starting, a lot of innovation. The existing businesses grow as fast as the economy, minus the growth that comes from new enterprises. So take that economic growth rate. Good rule of thumb is chop it in half. That's the real growth in existing enterprises. So if you're looking at 2% real growth plus your yield, you're looking at a real return that's in mid-single digits if valuation levels hold. If valuation levels mean revert, you're looking at low single digits. But it's nowhere near as challenging as the US, where the valuations are, well, they've been higher than these valuation levels only once, peak of the tech bubble.
So it is said that the 4 most dangerous words in investing are, this time it's different. But would you say that interest rates are different this time round? When we saw 15% interest rates in the early 80s on US treasuries and 0.5% now, is it different?
The short answer is yes, it's different. When the words this time is different are seductive because they're always true. It's always different this time. It's just usually not different enough to matter. And that's why it leads us astray. Mark Twain famously said that history doesn't repeat, but it sure rhymes. So as I look at markets today, do I think the COVID experience is going to change the way we do business in lasting ways? Yes, I think handshakes are probably not going to be nearly as popular for a generation. Okay, that's fine. I think flying across the country or across the world for a meeting is going to be less popular for a generation. I think having an office tower where everybody shows up for the same 8 to 12 hours a day is going to be much less popular than it used to be, because we're finding, yes, in many industries, ours in particular, working from home, you can be just as productive as working at the office. What you lack is the human interaction, and we could go on about how that is allows drama in interpersonal relationships and allows people to create stories about what's going on without the opportunity to check those stories. But never mind that. The simple fact is, yes, things are different. Are they different enough to matter? On the interest rate front, yes. The abandonment of the rentier, of the fixed income dependent retiree is daunting. And it is absolutely stunning to me that there's been so little attention in the media on how much damage we're doing to those who are dependent on fixed incomes. I think I'm shocked at how little attention it gets that pensions are severely underfunded if you use market interest rates as your discount rate. The argument is, well, we've always earned more than those market rates. Well, the simple fact is you earn more than those market rates either because of a risk premium, and a risk premium exists because it's risky and it might not happen, or because of alpha. And alpha is a zero-sum game less costs. It's a negative-sum game. So is it worth it to pursue alpha? Absolutely. But is it an assured incremental return? Absolutely not. I think the correct discount rate is risk-free long yields, because anything above that is something you're expecting the market to deliver, which it might deliver or might not. And so it allows you to distinguish between, here's how much I know I can cover in future spending, here's how much I hope the markets provide, and here's how much I have to make up through future contributions. But this time is different on the interest rate front, and it's different in a lasting way. I don't think we'll see a return to substantial positive real yields for many, many years, quite possibly for a generation. Interest rates could easily rise if inflation comes on the scene, but real rates, I think, will remain negative across the developed world for many years to come. So the COVID-19 lockdown and the stimulus-induced bubbles are different this time and are creating an environment where the asphyxiation of the rentier becomes a very real problem. Many other things are not different. You make money through yield, growth, and mean reversion and valuations. And you can still do that arithmetic, and that arithmetic historically predicts 10-year future stock market returns with about a 2% error. So if we're expecting zero real for US stocks, we could easily be underestimating. Things could be better than that. Less mean reversion towards historic norms. No mean reversion gives you a 3% real return. Full mean reversion gives you -3. So we're looking at that range. It's not an exciting range. And if you look around the world, you can see lots of markets where forward-looking returns are actually pretty good.
So Rob, in India, we are just in the early stages of launch of factor-based mutual funds, so smart beta funds. The first 2 or 3 funds have just been launched, and you have done a lot of work on fundamental-based indexing rather than capital-weighted index. So could you just share briefly your thoughts on how it works and what are the lessons for an emerging country like India?
Sure. Well, firstly, factor investing is simply a matter of quantitatively applying tilts to your portfolio in the direction of things that you think will be profitable. Most factor models, all factor models, include a value sleeve where you're going to tilt towards companies that are trading cheaper. That is believed to be a source of incremental return, and in the very long run, it has been a source of incremental return. It has not been a reliable source of incremental return. So folks in the factor community say the value sleeve is not very reliable, so we have these other components. We have momentum, we have quality, we have low beta, and the list goes on. The simple fact that is glossed over is that every single factor has long dry spells. For a low beta investor, the performance from the 1960s to 1990 was superb. Then there was a crash in the 90s for low beta, falling far behind the tech bubble, and you have never recovered that crash. You're underwater on a 30-year basis. Wow. For momentum was relentlessly successful in the second half of the 20th century. And that's when it was discovered and published. And since 1999, it has flatlined, or a little worse than flatlined. It crashed when the tech bubble burst, it crashed modestly. When the bear market turned in 2002 back into a bull market, it crashed fairly seriously. And then it struggled back to a new all-time high in 2008. And then it had a doozy of a crash, losing 35% in a single month in April of 2009. And we're way below that 2008 peak today. And we're well under where we were at the 1999 peak today. So that's 20 years with momentum not paying off. Every factor has its vulnerabilities. The thing I love about fundamental index is it is simple. It simply says, let's weight companies according to their macroeconomic footprint. If a company is big, we'll have a big weight. If a company is small, we'll have a small weight. Now, there are companies that deserve their premium multiples, but it's in the price. You don't have to overweight it just because it's expensive. Cap weighting overweights it just because it's expensive. It will boost your return if it exceeds those lofty expectations. Fundamental index says, thanks for those nice gains, I'm going to reweight you back down to your economic footprint. Companies trading at a deep discount, well under the market, out of favor, unloved, terrible headwinds facing them. Are they better companies? Of course not. But it's in the price. So fundamental index says, I'm only going to be hurt if the outcome is worse than today's bleak expectations. And therefore, I'm going to say thanks for the deep discount and I'll top you back up to your economic footprint. By weighting according to the fundamental size of a business, you have a highly liquid, tradable portfolio that doesn't have a huge small cap bias. You have a portfolio where every time a company soars and its fundamentals don't, you're going to trim it. Every time a company craters and its fundamentals don't, you're going to top it up. So you're contra-trading against the market's constantly changing expectations, fads, bubbles, and crashes. So what we find is that, yes, it's got a value tilt similar to the value indexes, but it has an alpha relative to the value indexes of about 2% per annum. So to the extent you want value, do it with fundamental index.
So Rob, there's so much more to discuss, and I would have loved for this conversation to go on, but I think the next session will be up in the conference soon, and our allocated 60 minutes is up. So it's been a pleasure talking to you, and thank you so much for taking the time out and addressing all of us at the India Wealth Management Conference. Thank you so much.
Thank you very, very much for reaching out. I've enjoyed this immensely.
Mr. Arnott and Mr. Thakkar, thank you so much for sharing your insights with us today.